Welcome to the Intermarket Analysis video update. This is a weekly video where I look at things other than what I usually look at every day. We look at the valuation of the S&P 500, we look at other markets, we look at a bunch of correlations, we look at the sectors that make up the S&P 500 to see if we're getting any insight as to what's ultimately happening with the S&P 500. Now, if you watch these videos on a regular basis, there's one change, and I mentioned this a week ago. We were getting really close to a bearish cross with the Japanese yen to the US dollar. Hadn't quite happened a week ago. Well, now it has happened. And so we have two things on the negative side. Everything else is still positive. So not a lot of changes this week, but everything else is positive for right now. But we're seeing some subtle changes right now as the market's trying to figure out, okay, we still have a government shutdown. We're not getting any economic reports, but earnings are still looking pretty good. But then there's this trade war between the US and China. Is that going to affect things? We see parts of the market becoming more defensive. Other parts are holding up pretty well right now. So let's go through this. And this is being prepared for Monday, October 20th. First of all, I'll go through valuation, historical and then forward looking. We do a pretty extensive study of growth versus value. Then I go through inflation and see if that's really a problem according to what the market's saying. And then other markets that we look at, then the 11 S&P 500 sectors, I look at them as individual charts, and then we do a ratio with the S&P 500. We look at a lot of different indexes, some correlations between different markets, then some very long-term trends, mainly using monthly charts there, and then at the end I have a positive and negative list. First of all, we look at valuation. No change here. It's what's been going on for a number of years now. If we look at historical earnings reports and what the price of the S&P 500 should be, we should be about at this red dashed line. That's not where we're at right now. We're quite a bit above that. So when you look at historical earnings reports that have already come out, yes, we are overvalued, but we've been overvalued for quite some time. This also shows that going back to 1980. And you can see there are many years at a time when the market is considered to be overvalued. This is another way of looking at it. The Shiller PE ratio also coming in very high at 39.79. To give it a little bit of perspective, we can look back on the chart and see, we're not as high as we were right near the dot-com boom before the dot-com crash, but we're still coming in high here. And then over a period of time, the median and the mean has been between 16 and 17, and we're at 39. Yeah, we're expensive. But we've been seeing that now for years. Then we look at forward PE ratios here. This is the mega cap 8. Even coming down just a little bit, this is still quite overvalued. Even when you look ahead, we're at 29.9, just a notch below the 30 level. We still use the 10, 15, 20 scale when evaluating this. We look at the S&P, which is coming in at 22.4. And then down here, we have the S&P 400 and the S&P 600. That's why I use the S&P 600 small caps. There's another index called the Russell 2000, which is probably more popular, and it's what I used for a long time, but it doesn't line up as well with these PE ratios because they can standardize it using S&P indexes here. But the mid caps and the small caps are more fairly priced, with the mid caps coming in at 15.9, that's blue, and the small caps coming in at 15.3, that's in green. Then we look at growth versus value. First of all, we look at this all by itself. We're not seeing an awful lot of strength in growth right now, but not a real breakdown either. We're still dealing with the 50-day moving average with the growth index, a little bit above the 50-day moving average with the value index. And then we do ratios between the two. So you can see here, this shows growth is outperforming value on the top. An inverted version of that same ratio shows value is underperforming growth on the bottom. We look at some ETFs showing how growth is outperforming value. Value is underperforming growth. Some indexes, growth outperforming value, value underperforming growth. Do you see a little theme going on here? And we look here at, again, these indexes. I'm hitting the wrong arrow here. So the growth index outperforming the value index underperforming the growth index. This is a couple of ETFs, a growth versus value ratio here. Not showing a lot of strength now, but still at the high end of the rainbow. This is that same thing showing how value is still underperforming growth. Then we look at the small caps. Now, we're not really breaking out with small cap growth to value here, but we're not breaking down either. We were showing some weakness here, enough to generate a death cross. But about the time that happened, we saw growth really starting to outperform, but we're still not above this recent range that we've been in. But this is looking pretty good for right now. And mid caps, even though the index is just kind of drifting down and not really going anywhere, the growth to value ratio is still holding up, even though it pulled back. We're still well above the 50-day moving average. This is where we're a little bit more concerned. Right at the beginning of August, we saw this ratio coming down with growth to value for the S&P, and it cannot seem to get back above its 50-day moving average. Now, longer term, we're in an uptrend. But going back to August or so, we've seen this really going sideways in anticipation that maybe the market is due for some kind of a decline. Well, it didn't happen in August. It didn't happen in September. And so far, it hasn't happened in October. So, but we still see this ratio hanging out about where it's been. And we look at inflation, and as I've been pointing out here, this bottom chart is a proprietary chart put out by Martin Pring. Now, if we look at just this chart, we would be quite concerned about inflation. This is an inflation to deflation ratio, but we're not seeing that in any other inflation charts that we look at. So this is more of an outlier right now. We still want to respect this. It's a monthly chart, but this continues to go up. Now, on top, we have the CRB index monthly, but it's not really going anywhere right now. It's actually dropping below its moving average. Then we look at a daily chart, the CRB index, also pretty much chopping sideways. We look at the Baltic Dry Index, and it's still in an uptrend here, and this could potentially be somewhat inflationary. This is what does it cost to ship products in the Baltics? And as a general rule, when this is going up, that's more inflationary. When this is going down, that's more deflationary. But it's not showing a lot of conviction currently. And what's the market think of it? Inflation expectations. They're actually trailing off here, but not really breaking down below this recent range that we've been in. Another ratio looks at inflation expectations to tips, and this is still continuing to go down as well. Then we look at aluminum, which has been coming back up here and is just starting to generate a golden cross here. So aluminum is now in an uptrend. Corn is in a downtrend, though, and wheat is in a downtrend. Fertilizer has been coming down here. That's not inflationary. Lumber, chopping around all over, just generated a recent death cross. Now it's starting to cross back above the moving averages, but it's still in a downtrend. And then oil is continuing to drop off here. We're getting into the mid 50s. We look at an oil to 10-year yield correlation, very strong correlated relationship right now, meaning that they're going in the same direction at the same time. We also look at gold to oil, and it's not that oil's doing well, it's that gold is doing quite well, and that's why we're seeing this ratio really popping up over here. Gas is still in a downtrend. Heating oil is still in an uptrend here, but not really breaking down or going up all that much right now. The moving averages are right on top of each other currently. Natural gas is still in a downtrend, but it has been coming up. Now it's starting to come back down slightly. Then we look at diesel, which has also kind of been chopping a little bit lower for the most part. And copper is still in an uptrend here. It pulled back from some recent highs, but this is another barometer of the economy. If this is going up, that tends to mean that the copper market anyway thinks that things are looking good economically going forward. Copper to gold ratio continues to go down. Now copper's been going up, but gold's been going up even more, and that's why we're seeing this ratio going down. This is a longer term look. The spread, the black line, still continues to go down here with the ratio. We're also seeing a general lowering here of the 10-year yield and the 2-year yield as well. Gold, it came off of its highs on Friday, but this is just the gold ETF. It did set an all-time high on Thursday. And silver came down on Friday, but set an all-time high on Thursday. And then we look at our gold to silver ratio, and even with gold going up, for the most part, when this ratio is going down, that means that silver is outperforming gold. And silver is cheaper, and so if it goes up, it doesn't have to go up as much to actually outperform gold. But Then we can plot the US dollar index down here, and we see that there's a pretty strong correlated opposite relationship. So if this ratio is going up, this then that usually means the US dollar index is going down. And so when we get a really low reading, that just means they're opposite of each other. The dollar was, again, what I've been attributing a lot of the gains to going back to last April is the dollar going down because the stock market likes a weaker dollar, and we're still in a downtrend here. Even though we've been seeing a bit of a bounce, it's not really falling apart, but it's not showing an awful lot of strength right now either. And then the euro compared to the US dollar index, and then the yen on top with the euro and the US dollar index, just to give you a visual look at what it's at. And then I break it out. This is where we're actually seeing a change. We've gone into a death cross now when we compare the Japanese yen to the US dollar. But we're still in an uptrend, just slightly below the 50-day moving average when we look at the euro to the US dollar. And the 50 period moving average is going down, but we're still hanging out around it when we look at the British pound to the US dollar. And some different ratios here. This is the weighted versus equal weighted version of the S&P. Not really getting out of line with each other all that much right now. This is another way of looking at a ratio. Lately, it hasn't been moving all that much, but in the longer term, when this is going down, that means the equal weight version is underperforming the weighted version of the S&P. And that's when you hear them say, oh, there's only a few stocks that are really driving the indexes. It's been true when you look at this overall ratio. Then stocks to commodities shows stocks outperforming. This shows commodities underperforming stocks. The S&P 100 is outperforming the S&P 500. The Nasdaq is outperforming the S&P 500. The Nasdaq 100 is actually back to outperforming with a little more conviction here, the S&P 500. But we're turning up a little bit here. The Nasdaq 100 has been underperforming the Nasdaq. Now we're starting to see this come up just a little bit and crossing above its moving average. Now, again, as I point out every time lately over the last few months, you could take this as negative, meaning the Nasdaq 100 is the big stocks. They're not performing as well as the whole big Nasdaq composite. Well, on the positive side, you could say, well, that just means the Nasdaq, a bigger composite, is doing even better. So maybe that's more positive for the market. Well, we're not seeing a real shift yet, but we are seeing where this ratio is beginning to change. So we'll keep an eye on this. The mega caps are outperforming the equal weight. That's where a lot of the strength continues to come from in the markets. Then mega cap growth all by itself, above both moving averages in a solid uptrend, still looking quite positive there. And small caps, even though they had a good week this past week, they're still not really outperforming the S&P 500. Robotics and AI ETF still looking fairly positive when we look at it by itself, but continuing to underperform with this particular ETF when we compare it to the tech sector. And small caps trying to bounce back up here. This is that same ratio we were looking at just a moment ago compared to the S&P, which is in blue. This shows how small caps are underperforming. Then small caps continue to underperform the tech sector. Again, we're going to be keeping an eye on this. We need to see more than just one or two good days and a little bit of hype behind the small caps. We want to see this get above the moving averages and eventually change this from a downtrend to an uptrend before we switch our stance on how small caps are doing. Dow Jones Composite, which is the Dow, the transports and the utilities, still holding up well above its 50-day moving average. Semis are back to outperforming the tech sector, and that's what we see in a more positive environment. Low volatility stocks, these are more defensive areas, just continues to chop along sideways and continues to underperform the S&P on a ratio basis. Now, when we look at the all-world ETF here that excludes stocks from the US, you can see this is looking pretty good here. We did come back, but we held above the 50-day moving average. But overall, this continues to be in an uptrend. Where we see it showing a little bit of underperformance here is when we put the US stocks back into the equation. We're just pretty much going along sideways. Now, longer term, US stocks are fine. It's just in 2025, we've been seeing them underperform all world stocks here and even at some points, European stocks. And we look at the energy sector to the tech sector, showing that energy is underperforming tech. Then growth stocks are outperforming bonds, even though bonds have been going up lately, but that's more of a flight to safety as the market's getting a little bit bit more concerned about what's happening with the trade wars between the US and China. But overall, this ratio is still holding up, even though it's below its 50-day moving average. Then the tech sector to the 10-year yield, tech sector is outperforming. This shows how the 10-year yield continues to underperform the tech sector. Discretionary had been doing well when we compare it to staples. It's coming back, and we'll see if this 50-period moving average provides support with this ratio. It'd be nice if this was to bounce back up here, but if this continues to show more weakness, that would cause us a little bit more concern. And this shows how staple has been underperforming discretionary, but coming right back up to its 50-day moving average as well. Gold, because it's going up, it's been outperforming the S&P 500 on a ratio basis. And with the dollar going down and gold going up, we're just seeing this ratio really going up as well. Then we look at advanced decline line studies here. The only one that's looking mostly positive now is the S&P 500, where we're above the moving average. Now, we improved on Friday with the NYSE common stock, mid caps, and small caps, but all of these continue to be below their moving average. Dow theory, not setting a high here with the Dow, just going sideways at best with the transports. Where we've been seeing a little bit more strength here is with the utilities, and they've been really moving to the upside. Then we look at a ratio between the Dow and the transports. We came back to this previous high here. We've been coming down, but when this ratio is going up, that means the Dow is outperforming the transports. And these are the transports themselves, which just continue to pretty much go along sideways. We look at the relationship or correlation between the S&P 500 and transports, sideways with the transports going up here, but there's still a pretty strong correlation between the two areas of the market. And this also looks at a ratio. This shows how transports continue to underperform the S&P 500. And then instead of using traditional Dow theory, we swap out the Dow and put in the S&P 500. That's holding up okay for now, but not setting highs this past week. And then instead of using the transports, we look at the NASDAQ, also just kind of chopping along sideways right now. To get a little bit more detail here, we use the equal weight version of the S&P. That's just been chopping sideways. And we use the equal weight version of the QQQs, the NASDAQ 100. That's just going along sideways. Then the FANG index, not really showing a lot of conviction, but still hanging out above its 50-day moving average. The Wilshire also above its 50-day moving average, as is the total US stock ETF. ARC, it's been doing quite well here. It's been in an uptrend, but it was down about 0.5% on Friday. And then the NYSE composite, not really setting new all-time highs now, but still above its 50-day moving average. All stocks, which are US and international stocks, still holding out above the moving averages. And high leverage loans, we're just a little bit above the 50-day moving average right now. And this is another barometer that we can use for the economy. And this is still holding up quite well. Japanese Nikkei index, just coming off of setting recent all-time highs. Bitcoin just got hammered a bit this past week. It's actually down dealing with its 200-day moving average, but it's still in an uptrend. And the micro caps holding up okay here, but not setting a new high this past week. And then emerging markets are looking pretty good. Came back down to the 50-day moving average and now continue to go up. And the SMH semiconductors, not setting a new high recently, but not far from an all-time high either. This is that same ETF showing how we're still above the rainbow. And then the AI and tech ETF, again, holding up fairly well right now, but not setting a new high this past week. Then we look at the S&P and the home builders ETF, and we see down at the bottom that there's a pretty strong correlation between the top chart and the middle chart. When we start to pay more attention to this is when we see them going in opposite directions of each other. Then, according to the KST momentum oscillator, China is in a downtrend, as are emerging markets. Europe, we're rolling over a bit in Japan, and we're actually rolling over here with the US as well. And on a monthly chart of a US to world stock ratio, still holding out above the moving average and still trying to go up here, but coming down just a little bit when we look at the momentum oscillator. Then bonds, based on price, we were really going up in a flight to safety. That set a high on Thursday. We saw that fall back a little bit on Friday. Total bond ETF in a solid uptrend. A monthly chart of the stock to bond ratio rolling over a little bit as recently bonds have been outperforming stocks, but this won't be an official chart until the end of the month. And this is a daily chart showing still, for the most part, bonds are underperforming stocks. Then the Pring World Bond Index here, we are in an uptrend, but it's been really choppy over the last few years. Then corporate bonds, which are more conservative bonds, they're looking pretty solid. And then junk bonds, they tend to follow more what the S&P does here, and they're still above their 50-day moving average. This is the junk bond ETF, which it did come down and fall below its 50-day moving average, but now it's back above that. And we look at a ratio between junk bonds and government bonds, seeing a little bit of a rolling over here. Government bonds, again, this flight to safety, that pushes bond prices up and interest rates down. And we see this ratio rolling over a little bit because of that. If this continues, we're going to get a little bit more concerned. But there's other times when we've seen this ratio start to show some weakness, and then it finally gathered itself together and was able to turn and go back up. And riskier bonds versus more conservative bonds, just not really much conviction right now at the lower end of the rainbow. The Dow Jones Corporate Bond Index just coming off of setting a high on Thursday, and a stock to bond correlation. And now they seem to be going in opposite directions. When we get a low reading like this, that means if one's going up, the other one's likely going down, and vice versa. And this also just shows longer term, the 10-year yield, how we've been establishing a higher range than what we had been seeing over the last 40 years. And this is a daily chart showing, for the most part, how yields have been coming down. And then we've been watching the red line here, which is the Japanese 10-year yield. Maybe the yen showing some weakness is preventing anything from happening, but this yield going up a year ago, it caused some problems. Now it's still continuing to go up, but there doesn't seem to be as many problems. Now we have seen a bit of a drop off here with US rates coming down, where UK rates are now the highest on this chart. And then German rates are in blue, and they did decline this past week. And we look at the volatility of stocks, that's the VIX, and the volatility of bonds, that's the MOVE index. And we do a ratio, or excuse me, a correlation down here. And we can see that the volatility is pretty strong, not price, but that the volatility is going more hand in hand right now with each other. Then we look at some stock to bond ratios, and you're going to see a lot of the same thing where we're at the higher end of the rainbow. This first one is the S&P 500 to 1 to 3 year bonds. Then this is 3 to 7 year bonds to the S&P. So it's inverted of what we just saw. This is still showing how bonds are underperforming. Then the S&P 1500 to 1 to 3 year bonds at the top end of the rainbow. Broad market to 3 to 7 year bonds still at the top end of the rainbow. The tech sector to 3 to 7 year bonds still near the high end of the rainbow there. The S&P 500 to the 10-year yield showing how stocks are outperforming. And then a monthly chart here of the long-term bond. It's finally crossing back above the moving average. Hasn't done that in a while. Now, this is a monthly chart. So again, it won't count until the end of October. But for right now, we are crossing above the moving average. And then we look at a ratio long-term of the long-term bond to commodities, where we've been seeing the long-term bond underperforming, and now it's starting to turn up. But again, we'll just have to watch this. We're only halfway through October, and so there's still things left before we want to really commit to what this chart is saying. Then we look at the 11 sectors, materials, and we're seeing a lot of money going into materials. We're just not seeing a lot of positive price movement right now. And when we compare it to the S&P, we're seeing how the materials are really underperforming. Then communication coming back down, trailing along its 50-day moving average, and not really showing a lot of conviction. It was improving here in August, and then it's coming back down. I mean, it's not turning negative, but this is one of the big growth areas of the market, and we would like to see this get back above the 50-day moving average with the ratio. Energy still hanging out around its 200-day moving average, but it is in an uptrend. But when we do a ratio with the S&P, underperforming. Financials. This is another area. We've been watching this really going back to last spring, where we did come down below its 50-day moving average with the sector by itself. And this is what's been causing a bit of concern. We've rolled over with the financial sector to the S&P ratio, and this is just continuing to get weaker. And industrials hanging out around their 50-day moving average and just generating a recent death cross here with this ratio. So these are starting to underperform the S&P. The tech sector, the biggest growth area in the market, this is still holding up quite well and actually looking pretty good when we do a ratio with the S&P 500. Staples, they were trailing off a little bit, showing a little bit of a bounce up here, but they're still below their moving averages, but underperforming, even though we've seen a recent bounce here with the staples to S&P ratio. Real estate just kind of humming along, going sideways and continuing to underperform. Even though this ratio is kicking up a little bit, we haven't come back above the 50-day moving average, at least yet. Utilities, this has been one of the stronger areas of the market too. They just seem to go to the moon. If you consider this now as a growth area due to AI needs and EV needs and whatever acronym you can throw in there. And we're still in a downtrend with utilities to the S&P, but this has really come roaring back lately. Then when this ratio is going down, that means the S&P is underperforming utilities. We want to see this ratio going up, and it's been a little bit more negative to see this ratio going down. Then healthcare, it's just generating a golden cross within the sector. So maybe this area has gotten beaten down enough so that a lot of people are looking for bargains. Well, this is also a defensive area. So if we start to see some more strength in here, that might mean the market is getting more defensive, which means getting ready to go down. But when we compare it to the S&P, still has a long ways to go to start outperforming the S&P. Discretionary, still hanging out around its 50-day moving average with the sector and still underperforming when we compare it to the S&P. There's a discretionary to staples ratio that we also look at. This is discretionary to the S&P index itself. And we were seeing some promise here, but now we're not seeing as much promise as we were before. Semiconductors holding up quite well, just coming off of recent all-time highs. And the semiconductors to Dow ratio still well above this blue line. And then the Dow Jones Semiconductor Index didn't really do much this past week, but it's holding up well above its 50-day moving average. And then so we have gold up about 62.5%, a little under 62% if you look over on the left-hand side here. That's by far the best performing asset in 2025. And then in a distant second would be stocks. And then we have bonds based on price. Purple, that's commodities. Then the dollar. And now oil is back to being the worst performing asset so far in 2025. Then some correlations here, still pretty much neutral when we look at stocks to the dollar. Then we look at oil to the S&P 500, pretty strong tendency to go in the same direction. And oil's been going down, and the S&P hasn't really been going up. It's not turning negative, but that's why we're seeing this fairly strong correlation currently. Then stocks to the 10-year yield also tending to go in the same direction. The tech sector is going in the same direction as the 10-year yield with the correlation. And then the stocks to the 2-year yield also tending to go in the same direction. Then some long-term charts. A monthly chart of the NYSE still looking pretty solid here, but we're still going down when we look at the long-term momentum oscillator, the Copic curve. We are coming down a little bit here with this monthly chart, but the NYSE record high percent index is still going up overall. And we look at a monthly chart of the S&P, still well above the moving average and also continuing to go up with the percentage price oscillator. And then another stock to commodity ratio here. We are seeing a bit of a turn up here. So, and we've been seeing that over the last few weeks. And it's like, okay, if we're concerned about inflation, we would actually see this continue to go down rather than going up. But we're actually seeing stocks improving when compared to commodities longer term. Then this is the other US to global index here, still above this long-term trend line here, but we're still going down with the KST. And we look at all the positive things. And if you've been watching this for a while, this list is all the same. The only thing that I took off of here was the Japanese yen to the dollar. And now over on the negative side, we not only have the dollar index by itself, but the Japanese yen to the US dollar is also in a downtrend. Thank you. I hope you found this helpful. I hope you're having a wonderful weekend, and I will talk to you in the next video.